Hello, everyone. I'm Perry Sykes, and welcome to the Investor Resources Podcast. Today, we're going to talk a little bit about the stock market, as we do so often here. But today, we're going to take a look at the way the stock market changes, why that's important to us, why we actually need that change, and why you need to have an adaptable process for investing your portfolio, because the fixed process is too far out of step too much of the time because of what happens in the market and how rapidly that happens. And let's get going here. The one of my favorite writers of all time in the stock market, a gentleman named Jesse Livermore. Now, he is one of the most storied investors in modern investing in the United States. Modern, if you go back far enough. Jesse Livermore was investing from the late 1800s to the early 1900s to the 1920s, say. And he's famous for having made and lost, three fortunes in the stock market. And a lot of his biggest lessons are coming from those losses that he incurred. And one of his favorite quotes, one of my favorite quotes from Jesse Livermore of all time was, and I quote, "Another lesson I learned early is that there is nothing new in Wall Street. There can't be, because speculation is as old as the hills. And whatever happens in the stock market today has happened before and will happen again." Boy, is that important today to understand that. We have an unprecedented number of writers saying unprecedented things are happening in the stock market. And it's important to know that as unusual as things are, whatever goes on, it's probably happened before, because, as he said, speculation's as old as the hills. That's always driven by human beings, and human nature is the one constant across all markets, all market cycles. Even right now, when we have so much robotic trading going on, the algorithms are out there working all the time. High frequency traders set that algorithm up and just turn it loose. And there's less and less human interaction with anybody actually hitting a buy or a sell button at any given time. But human nature is still built into those processes. Those are still driven by what it is we want to do. AI, artificial intelligence, isn't even going to change that for right now. Everything is still a reflection of human beings, what people think about. And so it's very important that you never forget that the human part of what's going on, we're the weakest link in all of this that goes on. The data is usually correct, and we mess it up. It's important to remember that fear and greed are still the two biggest drivers in the stock market, even with all the algorithms and the robotic trading going on. You see it time and time again. Huge moves in the stock market based on fear or greed, driven by headlines that shouldn't really have that kind of effect on the market anymore, but they still do. And so it's important to remember what drives the market, and that what we're looking at on a day-to-day basis isn't necessarily the same things that we're used to seeing. If you're a pie chart investor and your portfolio is built on data that runs back to the 1920s, it's important to know how different that is than what's going on today. Here's a great chart. Let's throw it up here. Looking at the difference between 1900 and 2025. In what was going on in people's portfolios. Look at this. In 1900, railroads, huge chunk. Benjamin Graham, he wrote The Intelligent Investor, one of the most famous investing books of all time. If you read it, he's talking about railroads all the time. And that's because in the 1940s, when he wrote the book, railroad stocks ruled the day. They were absolutely in charge of what was going on in the economy. And if you are a pie chart investor, this chunk of railroad dominating all the economy and all investment markets is still part of your portfolio. I'm not sure it should be, but it still is. And even in the United States, look at this huge slice of tobacco, probably don't look for that today. And I don't know how many of you have checked your telegraph allocation lately. It was significant in 1900. In 2025, you'll see the telegraph allocation does not exist anymore. And we're really big in technology. Technology is the main driver. Industrials, healthcare, retail. There was no retail market. Nothing. Food made it in, had to eat. Retail is not in there yet. It just didn't exist yet. And over the United Kingdom, very similar, huge chunk of rail. Half of their market was railroads, industrials, textiles, mines, and then of course the bankers. Banks have always been there. Now they don't have anywhere near as much technology as we have in the United States, but it's still industrials and banks and health and energy. The mines are still in there. uh, but it's very different in makeup from what it used to be. So it's not the case that what did rule markets, railroads, now rules markets, mostly in the United States. We're the largest market on earth, and it's technology that is the largest driver of what's going on out there. That's a huge shift. And that needs to be reflected in your portfolio. You can't pretend it's the same thing. And to have this rolled into your 2025 portfolio, this allocation breakdown does not make any sense. That's why we stopped doing that. So it's important to keep in mind how much these things change, and how much a difference that makes in what's going to be happening in your portfolio, and why sometimes when the headlines change, markets change so fast. The other big thing is, who owns it? Who's owning what we're dealing with here today? And again, things change significantly. If you looking back, the stock market was heavily concentrated in the hands of households. Not the case anymore. Households still have the highest ownership, 38%, but that's down from 90% in 1945. 90% was in households in 1945, and now it's 38%, mostly because of the fund industry. The fund industry controls more than a quarter of the stock market, and international investors, almost 20%, 18% are international, which didn't used to exist at all in our market. So there's a huge difference. Eggs are in a lot of different baskets now instead of just highly concentrated in just households. And obviously households still own most of the stocks in the country, but there is far more diversification. That's a good thing. And a lot of the household ownership are through these other vehicles. They're through mutual funds, people's 401k plans, pensions, and government retirement plans. Huge piece of the pie. But there's still a lot of just individual ownership. But again, this breakdown has changed so much over time. Again, this household number was 90% in 1945. So who owns what has changed a great deal. And just remember that when you say, again, we see so many headlines about, oh, BlackRock, the largest stock owner on earth, and between BlackRock and Vanguard and, State Street, they own everything. It's like, no, the households still own it. They just own it through the vehicles that they're operating. So the structure has changed. What gets traded has changed because those households aren't making the decision anymore on all of that, on 90% of the stocks that are owned. The funds, the households are invested in the funds make the investment decision. So that changes the nature of what happens. And so it's not just individuals buying and selling today. It's much more institutional buying and selling. So that's a good thing. It's more diversified than it used to be. But again, it's just important to remember that it's very different from what we're used to seeing over time. It's changed significantly, and that's going to continue. What does the future bring? We don't know. We have to wait and see. That's again why we need to be adaptable. We need to have a process that's going to allow us to say, that that old allocation and those old market drivers, and the way people react, that's not the case anymore. But if you're a pie chart investor and you're just invested as you were over the past 25, 30, 80 years, and you have all of that ancient data in your portfolio, which is not just not relevant, the basis for it doesn't even exist anymore. It shouldn't be part of what your decision making process is at all. And it is because it makes it easier for your stockbroker to throw you into a buy and hold portfolio and leave you there. And their only job is to make sure that your money stays in place. It's got nothing to do with what's reflected in the markets today, what moves markets today. You don't want your portfolio stuck there, and yet that's what happens to so many people so often. And let's take another look here at a performance quilt, which you've seen before. If you've been here with us before at Investor Resources, we like to watch what happens over time. This is the ranks of country stock markets over the past 20 years. So each one of these squares is an entire year in a country's stock market. And from 2005 to 2024, of course, as we all knew, Denmark was the top returning market on planet Earth. Anybody have that in their portfolio that Denmark was number one? I guarantee you, I did not. But there it is. That's why you need to track the data. Even knowing that, when Denmark down here in 2016 was the bottom of the list, number 20, who held on to it for a year? And the answer is nobody should have. Nobody should have been stuck there in a static allocation system that didn't allow for change. So even though Denmark has done great over that time frame, that doesn't mean every year is a good time to have it. You can see the U.S. up here. We got 1 year. 1 year is number one market in all 20 years. But here at number 3, we're up there a lot. Number 2, that's why we ended up as number 2 on this list. But if you look at other, like European powerhouses, you're looking at Germany, quite a ways down behind Singapore and Switzerland. Not necessarily something that would have come into mind. And it's important to remember this, because look at the United Kingdom, even below that. So below Germany, it's very chaotic. Can you imagine trying to just guess who's going to be number 1 next year, trying to market time your way to better investment returns? Not likely to be successful. It changes too much. The stock market is highly schizophrenic, in the best way possible that I could say that. So it just doesn't make any sense if the rankings were the same every year. If everything was the same, it would take all the fun out of the market. Fun in quotes there, not necessarily fun, but the stock market has to change over time. You have to have that turnover. Otherwise, there would be no risk premium for the stock market. If it was just easy to see what was coming next and who was going to be in charge and where the big returns were going to come from, everybody would do it. You have to be willing to put in the work. You have to be willing to follow the trends, and you have to be willing to be adaptable to current investment conditions and not say, well, for 10 years, this has done really, really grand. I'm just going to let this sit. I'll never forget way back before the tech bubble in 2000, before the tech bubble burst in 01 and 2, had some clients that were Microsoft employees. They got these fantastic Microsoft employee stock option deals. And I asked them once, when are you going to begin to sell some of these? And when they were in for a meeting, and one of them told me, one of the spouse told me, well, no, we would never sell Microsoft ever. That's something we're never going to sell. And I remember there were 5 consecutive years Microsoft was up 100%, 5 years in a row. It was absolutely the gold standard of capitalism. Doesn't always stay the same. It doesn't matter how good it's been. And of course, time to sell Microsoft came. It's a difficult decision, but that's the kind of thing you have to do. If you're wondering if you're still in the right place, if you're wondering if your portfolio reflects where we are and what we're doing now, we'd love to go over that with you. The contact information is going to come up on the screen here. Send us your portfolio. We'd be happy to go over it, see where it is looking, how it looks in current trends, how things are going. If you enjoyed this podcast, hit that subscribe button. You're going to keep getting our most recent updates. Stay with us. Thank you for joining us today. See you again soon.